Good day, everybody. We are here to give you the latest developments in the Nigerian financial market. So, the Central Bank of Nigeria, in collaboration with Financial Market Dealers Association (FMDA), introduced a new benchmark rate called NOFR, that is Nigeria Overnight Financing Rate. So, many are asking, oh, what does that really mean? What is the implication for the financial market? Does that mean that our MPR is done, this and that? Here, I will give you a short explainer to some of these questions you have been asking. So, first and foremost, just take it like this: fuel prices and the cost of transportation. Whenever fuel prices increase, it means transportation cost is going to go up. So, same goes to NOFR. NOFR will now serve as a benchmark rate in the Nigerian financial market, meaning that if I want to borrow money before any loan will be approved, they have to look at what NOFR rate is saying. It doesn't mean that they are going to approve loan for me. The exact rate that NOFR is saying, no. It's just that NOFR will provide a guide to what the interest rate environment is saying. So, in pricing loans, pricing assets, even collateral for valuations, NOFR will now be the rate to consider whenever you are doing your valuations in some of these areas. Before the introduction of this NOFR in the Nigerian financial market, whenever an asset manager wants to price a collateral, a trader wants to approve a loan, and so many other things, they may have to go through rigor calculations and methodologies like using of Nigerian treasury bills yields or using of federal government bonds yields. Some of these things are the variables that the market do use to compute the rate or to get an overview of what the rate in the market is saying. With NOFR, some of these things may not be necessarily applicable again because you now have a benchmark rate that you can look up to know what the market is saying. So, and this development is not just peculiar to Nigeria. The United States moved from LIBOR to SOFR in 2022. So, SOFR is now their own benchmark rate. In the United Kingdom, they have Sonia. Sonia is their own benchmark rate. In the Eurozone, they have something called ESTR. So if you go to other markets like Japanese markets, the South African, they also have their own benchmark rate that they are using. So meaning that Nigeria has now aligned itself. Nigerian financial market has now aligned itself with what's obtainable in other financial markets globally. So what this new benchmark rate will provide for the market, one of them is, so it helps in risk management and it also helps in monetary policy transmissions. So when monetary policy committee are going to decide on rates, they are not just going to be deciding on rates just like that. They have to look at what's also happening to the benchmark rate. So lastly, does that mean that NOFR is not replacing MPR, or is it the same as MPR, that is monetary policy rate? No, they are not the same. The difference between NOFR and MPR is that NOFR is market determined. It is determined by the transactions in the interbank market. That is the transactions between banks, the rates between them. These are the things that determines what NOFR will be. While monetary policy rate, MPR, is solely determined by the voting of monetary policy committee. So meaning that when we say vote, it means the majority will carry the vote. So it is the vote of the monetary policy committee that determines MPR. Why market, that is the interaction between supply and demand in the interbank transactions, that determines NOFR. Thank you. See you next time.